Hey traders, Nick here. Quick statement about the state of affairs in the market. I'm laughing at the recording software. It's like a surprise every time I click it. It just shows up in a different area of the window. Anyway, it's like, where is it? So today is the 14th, big day, like massive day in the market, especially in the Nasdaq. I mean, this is the whatever am I looking at? AMD up 8%. Apple was up like 5%. The Qs were up 4%. That's an index up 4%. So somebody said, well, how are the fundamentals going? It's going to crash and all of that. So the simple statement against it, I'm not saying that we won't fall from here. In fact, we should fall from here. The fundamentals are hideous, absolutely hideous. So self-inflicted. But here's the math about it. The Nasdaq, the top 5 or 6 stocks in the Nasdaq, which are the ones that are immune to this, almost immune. The services like, first of all, Amazon. Amazon has never been busier, ever. So people are surprised, why is it at all-time highs? It's never been busier. Does that sink in? It's as busy as it's ever been, and then some. So why shouldn't it be at all-time highs? That's the statement there. So Facebook, Amazon, Google, Microsoft, they're all services. Microsoft blended, but the new Microsoft is more services than products. And even if it's a product, the sell cycle is longer than somebody selling meals or not shoes, like restaurants, for example. Those guys and girls are in big trouble, and if you interrupt 3-4 months of business, or 2 or 1 week sometimes of business, it's a ding that they may not even recover from. Well, for somebody that doesn't buy a PC but once in a blue moon, doesn't upgrade phones and once in a blue moon, it's not as crucial to wait an extra 2 or 3 months. It happens all the time. That's why they change the forecasts on the quarters for Apple, for example. So the ones that are not heavy on products that flip fast, like a pizza, actually pizza delivery, that's pretty good actually, but a restaurant in general. So you get the point. So take the top 5 or 6 stocks in the Nasdaq. They're more than half the whole index. So the whole index cannot fall too far, because these big guys who will do well in a bad period of time are going to prop it up. So if I were to short a market, the Nasdaq would not be it. What would I short? I wouldn't short the Dow, because Boeing is a big part of it, and gas company, power companies. So, and banks are cheap anyway, so there's not a lot to fall from. There's not a catastrophe waiting to happen. So it's propped by the government, saving the airlines, saving the fuel energy companies, saving Boeing. So it's propped. So just think about the S&P. Some people want to get smart and short the small caps, but if you get caught wrong, the small caps runs twice as fast as the S&P. So the S&P makes the most sense. And if I wanted to short it, I can use the SPY, the SPX. What's the difference? The SPX is the actual index, the cash index. And this is a year's worth of action, okay? And the SPY is the ETF on top of the index. So companies go out and simulate the action of the index by buying and selling the companies that are in it in the same fashion. So don't worry about how they do it. It's one way or another. This one trades like a stock. The other one trades, if you're trading options, it's not the same as a stock. So you can't do a call calendar with the SPX. You can do it, or a put calendar. You can do it with the SPY. But this is getting in the weeds. So first things first, I want to say I am not here shorting markets. I am worried about the market's fundamentals. Why don't I want to short? The idiots of the world, I'm not talking just the United States, the idiots of the world shut it down. And their way of fixing this problem is by spending, I don't know, the U.S. alone is probably going to hit $10 trillion to fix this mistake. 10 trillion. That's, a trillion is 1,000 billion. A billion is 1,000 million. Does that sink in with people? Okay, so they're going to spend 10 at least. The starting salvo is 2 trillion just in the fiscal spending. Then you layer on top of it the money, what, 2-3 trillion from the Fed to start buying even junk bonds now. They haven't bought stocks yet, like Japan, but they're almost there. So that's the reason I don't want to short for sake of shorting just because it's too high. I want to short triggers, but I can protect. I can make bets. So if I wanted to take a bullish bet, different than just shorting. Shorting, you sell something, you need it to fall in order to profit. I can buy a put spread, very mild. It's shorting, but with limited risk and a big outcome and time to change my mind. Okay, so if I get caught in a short squeeze, I'm toast. Like the people that shorted Tesla today or yesterday. They're in the weeds. It was up 15% at some point. Or Shopify. This guy said it's a sell, and it's $100 above where he said it was a sell. Raymond James. So I don't like shorting. I can't take bearish bets, and that's what I'm talking about here. Please. This is not saying we're done, we're headed down to zero. Logically, business is toast for a couple of quarters. We're going to print the GDP that's going to scare the bejesus out of us. If not, it's fake news. But hey, it is what it is. So here's the thing. This is 1 year's worth of data. This is the high. That was crazy. This is the low. That was also crazy. Somewhere in the middle lies the truth. Easy for me to say. Where are we? Somewhere in the middle. In fact, I can probably... I've done this before maybe. What is it? Yeah, we're just above the middle, today's candle. So mathematically, this is totally normal. You fall this much, you recover half of it, and then there's a chance they fall again. So here's the thought. Technically speaking, if I'm going to go to a monthly. So now it doesn't look so bad, right? This is 1 month. It was as high as here, as low as here, and they're in the middle trying to decide what to do. So there's a chance that the market is doing this. They're going to bounce or consolidate for a period of time, and then they're going to realize what kind of a pit they're in and do this again. So we could retest the lows or set a new low. Technically, I don't see a trigger for it. So if I were to short, I usually want to see a trigger. Okay, they broke this, therefore they're going there. Like if they break out of this, I'll say chase up until this. But they haven't yet. So if I haven't started longs, I want a reason to go long. So it's more obvious on shorter term candles. So you can see here, like once they broke out of here, this was given almost. So I want to see levels. In fact, check. I'm glad I did this. Look at this. This is a reason to short or expect selling in this. So I expect them to start seeing selling here. In fact, if I had looked at this earlier, I would have taken some put spread overnight or sold a call spread. I'm a little bit short already for balance, but not like a hardcore short. Okay, back on task. How do I short, or how do I take a bearish bet? Not necessarily short. Very easy using options. Very easy. So if you haven't learned options, this is the time to learn. Hit me up. We'll schedule something. So usually I buy a put. And I say, if the market falls, I want to be short. Therefore, I'm going to buy a put. And I usually buy it. It's going to cost me X. And then it's pretty damn expensive right now because the VIX is still freaking 40. That's another reason why there's something wrong with this market. The NASDAQ was flat on the year. Not down. It was flat on the year. And the VIX is still at 40. And there is a mistake there. One of these two is wrong, okay? So either the VIX is going to collapse or the NASDAQ should give back some pretty quickly. Anyway, so this is expensive. The VIX high, it makes it very expensive. So I would have to spend a lot of money. So since I am not shorting outright, I don't want to do that. So I can buy one, since it's expensive, and sell one because it's also expensive. Then I neutralize the expensive fact, right? So where do I do that? That's totally up to individual preference. If I want to spend, a couple of $1,000s, I'll go wide. And why? Because if it does fall, if price falls through here, this put spread will balloon in value. So I paid, let's say, $500 for it. I'm just making up numbers. Then it turns into $2,000, and therein lies my short profit, my bearish profit. So if I wanted unlimited profits, I can spend a lot of money and make a very big short saying it's going down. I'm going to short it with big money. Then if I buy a single put and this happens, woo-wee, I can retire, basically. I'm joking, but it's a lot of money. The reward is big, but so is the risk. I am not that conviction. I don't have that strong of a conviction that I don't have a reason to short. I do have a reason to see resistance. That's different than saying an outright short, in my opinion. Okay, so I can do the same thing in the SPY or the SPX. It doesn't matter. The SPY will be cheaper, absolute dollars, because it's 10 times smaller in value, so it's cheaper to buy the options. But the percentage gains will be the same in percent terms, maybe bigger in the SPX dollars absolute value. So how would I short and when? So since we're doing a spread, I wouldn't use next week or the week after or the week after. I would go out to May or longer. I want at least a month on the clock, because a spread, believe it or not, a put spread that I buy will cost the same if it expires in 1 minute or 6 months if it's at the money or close to the money. I'm going to have to pay half the width. So if I choose a spread that's $10 wide, I expect to pay about $3 to $5, depends on how much lower below current price. And if I buy it at current price, I would pay $5. That's always a fact, half of it, because it's a coin flip, like buying a stock. Go up, go down, 50-50. The odds makers, the market makers, will give you 50-50 odds. We're talking gambling. Well, that's what stocks are. You buy a stock, you're gambling it's going to go up. You do homework to increase your odds. Here, the mathematical odds are 50-50 if you buy a put spread or a call spread at the money. It's always the case. So if it's a $5 wide spread, you pay $5, chance to make $5. Chance to double your money. How about that? Okay. So, and you can double your money way faster than playing with stocks. So I would usually go lower. So if current price is here, I would go down to say 2,700 and say, okay, if the stock market falls through 2,700 by a lot, I'm going to double my money. That would be one way to short it. I pay $500 per contract because it's $5, and I can change my mind. What does that mean? Let's say the next couple of weeks or couple of days, stocks keep going up, and you hear a couple of news pieces. You say, hey, it's not as bad as I thought. You know what? I can change my mind. I'll sell it for $3. So I only lost $2 per contract. I can change my mind. We're not going to crash up. Well, it looks like a crash up, but if I'm actively trading or watching the markets and I see a 10% rally, I'm going to decide whether I need to change my mind or not, correct? And salvage some of that bet. Versus if I short outright by selling something outright and this happens, then I'm underwater right away, and then you get a call from your broker saying cover your short. So I'm being asked, the reason for this whole video, I should have started with this. Family, friends, and members are asking, how do I short? I expect the market to get shellacked. Smart people are asking me this. How do I short? The easiest way to short, the safest way to short, in my opinion, is to buy put spreads. That's the safest, lowest cost. Where to buy them depends on my thesis. If I think markets are going to go and set new lows, I should buy them down here. They're really cheap relative to here. So a $10 wide spread might cost me $1, maybe $2. So what happens if price falls and I'm right? Then I turn $1 into 10. So the risk is a lot smaller than the total reward. The total reward is the width of the spread. I just used the $10 width as an example. And if it falls through both my levels, then I make $9. So the cost is 1, the full value is 10, the net benefit into my pocket after all said and done is 9. All right, so what values do I buy? Well, if I think it's going to go below 2,200, which was the low that we set, people say it's going to set new lows. So you're telling me that the SPX is going to fall below 2,200. All right. If that's the case, then I would buy a 2210 put and sell the 2200 put. Therefore, I'd be long the 2210, 2200 put spread. So I want price to fall through both legs, below 2200, set a new low like you told me it was going to, in order for me to make $9 for the buck I pay. I don't know how much it is, if it's $1 or not. In fact, I should probably go check it. Okay, we have facts and figures, peoples. All right, so first of all, I looked at May and I looked at June. The May prices are too low. What does that mean? Market makers are not that idiotic. The 2200 put is like $5, almost $6, and it only costs like 20 cents to buy the whole spread. It's just too cheap. So I went out to June. The June contract prices tells me that they expect plus or minus $300 move, which sounds pretty freaking low. How could that be when VIX is 40? So prices are weird. However, to buy an outright put for 2200 for June, it's like $2,400 per contract. It's a lot of money, but that $2,400 will explode in value if you're right. So the spread is still valid, and it's definitely over $1, unless the values I'm seeing right now are liar values after hours, so we can try this again tomorrow. But the example I was offering is still valid. So I'll pay a tiny fraction of the spread, and if you think it's going to set new lows and you're right, you're going to make a shit ton of money. So that's allowed. So, you know, technically, down move up and then down move equal to this one makes sense. I've been sharing in the write-ups. We have dueling scenarios. One is 2900, 2880 versus 2200. So we're almost at the 2900 worth. 2880. We're 40 points, 30 points away from it. This at the high today in the S&P. But so I'm just sharing what I can do. So these SPX values are a lot bigger than the SPY values. So the SPY values will be a lot less. So here's the thing. For my take, when I want to short something, I either make it a lottery ticket or I make it a conviction position. What does that mean? A lottery ticket is 2200. You know, the odds are very low. That's why it's not very expensive for May, for example. So what's a better setup? The better setup is just below current price. So I only need a small drop to start making real money. Why? Because I can guess, if I go down here, I can guess correctly, and it could crash 15%, and I can still make no money because I didn't guess the amplitude, the size of the drop. I guess the direction, but I don't guess the proper size, then I lose anyway. So you think you're pissed off if you lose money because you missed a rally. You're going to be pissed off if you guess right and guess wrong on how to make money on it, and you still lose. So for my eye, this was pretty telling. So I think we could test something, but this is pretty telling. I mean, here the world was freaking ending. Literally, the world was out of work. Literally, it's done. We're toast. This might make a better bottom, in my opinion. If we dip, we might bottom out again here. So what does that mean? It means that whatever spread I buy, I want to cover that gap right here, and I don't want to cover too much lower than this. So I would go out to May or June. June better than May, and I would buy a put spread somewhere down here. How wide depends on personal preference. I think the smallest width would be, if you're going with the monthly, would probably be $5 wide. If I make it $10 wide, the cost will be more, but the potential to make money is more with fewer contracts, fewer costs involved. I can make it $25 wide and just take one or two contracts. Depends on the side of the portfolio I'm trying to protect, if it's not a standalone trade. So I gave you just a whole bunch of ideas on how to. Okay, so one thing I didn't mention is selling call spreads, and I don't have to short it right here. So if I think by May or June we may fall, but you also think that we're more sure. I'm more sure that we're not going to make a new high, a new all-time high. Then what I can do is either buy the put spread or sell a call spread up here and collect some money. And if this doesn't come, I don't even need a rally to win or a drop to win. I won already because I collect the money now, and if price doesn't get there, that money is mine anyway, even if it rallies to it and dies. So leave room for error, basically. I can do both. If I really want to short, I'll sell the call spread, put the money in my pocket, use the money to buy a put spread, and if I'm right and this falls, then I'm short for free or for cheap. So you see, there are tons of things you can do. What I suggest is come up with the ideas, hit me with an email or message, and then we'll discuss it, and maybe I'll take your idea and join you. You'd be telling me what to do. And again, this is not a trade idea. This is, I'm answering a question. I literally was asked at least 5 or 6 times this week, I expect the market to fall. How do I short it? So if I'm expecting the market to fall, I just gave you a ton of ways to short it. Now, the easy thing also, if I owned a lot of shares, I would sell calls against those shares. Can you hear that? Calls against those shares, not naked calls, covered calls. Why? VIX is so high. They're giving me money, saying, hey, you've got shares, sell them. People are scared. Sell those calls. Make money while the stock is stalling. All right, Nick signing out.